Most people spend their entire lives working for money. A small group of people spend their lives making money work for them. The difference between these two groups is not luck, and it is not a high salary. It is a strategy, a deliberate, time-tested approach to owning the right assets and holding them long enough for compounding to do the heavy lifting. This is the asset strategy that quietly builds generational wealth, and it is more accessible than most people believe. The foundation, understanding why assets matter more than income. Here is a truth that most people learn too late. A high income does not guarantee wealth. A nurse earning $50,000 a year who consistently invests in appreciating assets will likely end up richer than a lawyer earning $200,000 who spends everything and saves nothing. Income pays the bills. Assets build the future. An asset is anything that puts money into a pocket over time: stocks, real estate, businesses, index funds, and even intellectual property. The opposite of an asset is a liability, something that drains money out of a pocket. Most middle-income earners spend the majority of their earnings on liabilities, cars, consumer debt, and depreciating goods, while the wealthy channel their capital into assets that grow quietly in the background. Warren Buffett understood this early.
So noble as to withhold investing myself just so that Greg could look good.
He bought his first stock at age 11 and purchased his first real estate investment before turning 20. By the time most of his peers were just starting their careers, Buffett already had a small but growing portfolio of income, producing assets compounding in his favor. Today, his net worth stands as a testament not to genius alone, but to decades of disciplined asset accumulation. The first pillar of the strategy is simple: stop trading time for every dollar and start building assets that generate returns independently. This requires a shift in thinking. Instead of asking how to earn more, the right question becomes how to own more. Ownership is the engine of long-term wealth, and the earlier someone starts, the more powerful the compounding effect becomes. A person who invests just $500 a month into a diversified stock index fund starting at age 25, assuming a historical average annual return of around 10%, could accumulate well over $3 million by retirement age. The same person starting at 40 would reach a fraction of that. Time in the market is not just a phrase, it is the single most powerful variable in the entire wealth equation. The strategy: building a multi-asset portfolio that works in every market. Smart wealth builders do not put everything into one basket. They distribute their capital across multiple asset classes, each serving a distinct purpose. Stocks deliver growth. Real estate provides income and appreciation. Bonds offer stability. Business ownership creates leverage. Together, these pillars create a portfolio that can withstand recessions, inflation, and market shocks. Stocks and index funds form the backbone of most long-term wealth portfolios. The S&P 500, which tracks the 500 largest companies in the United States, has delivered an average annual return of roughly 10% over the long run. Investors who bought and held through the dot-com crash of 2000, the financial crisis of 2008, and the pandemic crash of 2020 were all eventually rewarded. Patience is not passive, it is a strategy. Oprah Winfrey is a powerful example of multi-asset thinking. While her media empire generates massive income, she has also invested in real estate, a stake in Weight Watchers, and various business ventures. Her wealth is not tied to any single stream. Each asset class contributes independently, and collectively they compound over time. This is not a coincidence, it is architecture. Real estate adds another powerful dimension. Rental properties generate monthly cash flow while the underlying property appreciates in value. An investor who purchases a rental property and holds it for 20 to 30 years benefits from both income and equity growth simultaneously. Real estate investment trusts, also known as REITs, offer a more accessible entry point for those who cannot yet afford a full property purchase. They allow individuals to earn real estate returns without directly owning a building. Business ownership is where wealth can accelerate dramatically. Owning a stake in a profitable business, whether a small local operation, a franchise, or equity in a startup, provides unlimited upside that a paycheck never can. Jay-Z did not build $1 billion fortune on music royalties alone.
In ways, it's kind of like Uber. Hit a button, get an average album. I'm not saying that Magna Carta Holy Grail was a bad album, I'm just saying that you probably could have got the same.
He invested strategically in businesses like Armand de Brignac Champagne, Dieuze Cognac, and the streaming platform Tidal. Each of those investments became a standalone asset, generating independent returns. His blueprint reflects the same principle that applies to any investor: diversify ownership across multiple businesses and hold those positions long enough to realize their full value. Dollar cost averaging is the method that makes this strategy achievable for ordinary investors. Instead of trying to time the market, a tactic that even the sharpest professionals rarely execute successfully, investors contribute a fixed amount regularly regardless of market conditions. When prices are high, fewer shares are purchased. When prices drop, more shares are acquired for the same amount. Over time, this smooths out volatility and systematically lowers the average cost per investment unit. It is not glamorous, but it is enormously effective. Portfolio rebalancing is the discipline that keeps the strategy on track. Over time, certain assets outperform others, shifting the original allocation. A portfolio that began as 70% stocks and 30% bonds might drift to 85% stocks after a bull market run. Rebalancing means trimming what has grown and reinvesting in what has lagged, a counterintuitive move that locks in gains and maintains the intended risk profile. Reviewing a portfolio every 6 to 12 months is a widely recommended practice among financial professionals. The mindset, thinking in decades, not days, perhaps the most underestimated component of the entire wealth strategy is mindset. The market will drop. Recessions will come. Headlines will scream catastrophe. In those moments, the discipline to hold rather than panic, sell is what separates wealth builders from wealth destroyers. During the 2008 financial crisis, many amateur investors sold their holdings at massive losses, locking in damage that took years to undo. Long-term investors who stayed the course watched their portfolios recover fully within a few years and go on to reach record highs. The lesson is consistent across every major market downturn in history: time heals volatility, but only for those who stay invested. Jeff Bezos once asked Warren Buffett why more people did not simply copy his investment strategy, given how straightforward it appears on the surface. Buffett's answer was direct: nobody wants to get rich slowly. The culture of instant gratification pulls people toward quick trades, speculative bets, and viral stock tips. Real wealth, the kind that lasts across generations, is built through boring consistency, buying quality assets, reinvesting dividends, avoiding unnecessary debt, and compounding for decades. Rihanna built her Fenty Beauty empire not by chasing viral moments,
Hey, have you ever tried her makeup?
I thought you had a little Fenty.
but by owning equity in her brand from the start. Her decision to retain ownership stakes rather than merely collect a licensing fee transformed her from a celebrity into a billionaire entrepreneur. The distinction was ownership structure. She understood that owning an asset is always more powerful than being paid by one. Tax efficiency is also a quiet but critical part of the strategy. Placing high-growth investments inside tax-advantaged accounts like a Roth IRA or a 401 means that compound growth occurs without annual tax drag. A retirement account without proper tax location strategy can cost tens of thousands of dollars in unnecessary liabilities over a 30-year period. Placing the right assets in the right account types is a form of optimization that costs nothing but attention. The true power of the asset strategy becomes visible only over long time horizons. A portfolio that looks modest at 30 becomes significant at 50 and transformative at 70. Most people overestimate what they can build in 1 year and dramatically underestimate what they can build in 30. The compounding curve is not linear. It bends upward sharply in the later years, rewarding patience with accelerating growth. The strategy is not reserved for the wealthy. It begins with a decision to prioritize ownership over consumption, to invest before spending, and to treat assets as the foundation of a financial life rather than an afterthought. Start with what is available. An index fund, a small real estate investment, a retirement account, each one is a seed. Given enough time and consistent attention, those seeds grow into something extraordinary. Wealth is not a lottery. It is not a secret. It is a system, one built on owning assets, diversifying intelligently, compounding patiently, and thinking in decades. The people who understand this do not just hope to be wealthy, they engineer it.